Hey, Dan Fitzpatrick here. And this morning, Scott McGregor, Rocky Cleburne, and I recorded, we held a training session for our option market mentor group. And I showed up during the first part and the last part of it to talk stocks. There were a lot of important things. And so I've edited this out and am sending out my portion of it to you. The whole thing is over 50 minutes long. And so this is a long one for a free video. But the reason that I'm doing this is I want you to see the type of content that we're delivering to our members every week. We're holding 3 live training sessions a week. And so hopefully you'll get something out of this. And if you haven't tried Stock Market Mentor, I highly recommend that you do. Of course, I'm biased because it's my business, but we give you guys really, really good stuff. And I think you'll see it here. One of the things that I'm doing when I close these trades down is I'll look at my entry, I'll look at my exit and say, like, what's going on here? And I'll walk through a couple of these and tell you what I was writing to myself. The bottom line is I spotted kind of some common errors, not on every single one, but on a lot of them. And that is very simple. I was looking at breakout stocks, these breakout patterns, and the market is really heavy. There's just still a lot of selling. There's a lot of selling pressure. Nobody really wants to buy stocks. And, there's so much going on. I mean, for crying out loud, if you read Zero Hedge, you're going to think the world's ending tomorrow. I don't think it's ending tomorrow, but I do think it will end at some point. And so with the market so heavy, breakouts just aren't going very far. Even if they're going a little bit, they're ultimately going to reverse. And so as I look at these, one of the methods that I teach, it's something that I don't think anybody else does it. And that is draw boxes around where, if you're buying here, use that entry point right here as the upper left-hand corner for a box that you draw down. And then the lower left-hand corner for a box that you draw up. And then this is really, I'll get rid of this. This is really the analysis that you have right there. From where this stock is, right here. I mean, we know where it went, obviously, but from where this stock is right here, what are the chances that the stock is, from where it is right now, and here's where the 2 boxes meet, what are the chances that it's going to continue to go up here and never get down in this box, versus what are the chances that the stock would come down in this box? And we see what, we can see what the, what the answer is. But if we were to do the same thing, like if we were to do the same thing here, where the stock was just bouncing above the 50-day moving average and drawing the same box, I think it would be pretty easy to envision, since it's never gotten above the 50-day moving average, it would be much easier to envision that this is probably not what the stock is going to do, that at least it has a pretty good chance of falling, back into the box here. And so it's a way to kind of envision where things are going. Like, Scott, are you looking at any stocks right now that you might be interested in buying?
No, sir. Kind of a slow day.
Nothing at all. Okay.
Other than noting the strength in Apple,
okay.
That's something that I think, is clearly outperforming a lot of other stocks right now.
Okay. Great example. But you're not considering buying it, right?
Not today.
You wussy. So let's do the example. Let's do this here, because this is real-time stuff. So if you look at the stock this way, what do we think the chances are that the stock's just going to continue to go up and never come back in this box here? It's just going to keep going up. That's not really something that I would look at. I would think at least at some point, the stock's going to fall back into the box, just because that just seems to be the pattern. Now, here's the thing though. And then we can go ahead and start, Rocky. I kind of hijacked your deal here, but this is
not at all.
It's right on point, from what I'm dealing with now. So I think the stock has a pretty good chance, and I'll go ahead and leave these boxes up on my software so I can remember them. But I think a stock has a pretty good chance of coming down here at some point. Probably, maybe even if it comes up here at some point, I do think it's going to back and fill a little bit, maybe test the 50-day moving average. But here's the point of this exercise. Whether it happens or not is not really what I'm looking at. What I'm looking at is assessing whether this is an RHRN moment, a right here, right now moment. And I see this as not being the best time to buy for reasons that I've just mentioned. And that's all. It's like you said, Scott, not today. And that's really what I'm talking about, is you use this not as a predictive thing, but rather as a way to assess the risk of on any particular stock. And another scenario, a totally different trade, would be down here when the stock has pulled way back here, and then it's rallied up. And so let's say you're buying here and you say, all right, I think this was a big sell-off, then a big reversal. You can see the higher volume. So I don't think there's much of a chance for this stock to fall back in the box versus running higher. And so then what's my analysis, or what's my conclusion on this? Well, remember, I'm using this to assess risk. And I think there's less of a risk of the stock falling back just because it's so oversold. And I think instead it would blast through here. Okay, well, let's say I'm wrong. Well, the nice thing is, if I'm wrong, this would be the bottom of the box. So if I'm taking this shot, I'm risking like 2.5% on a trade where I think has a higher probability of moving higher than lower. So even if I'm wrong on this, my penalty, the dealer doesn't scoop that many chips from the table. And so this is just a simple method that I use. And I found myself today, as I'm closing down these trades, one after another, my notes are: didn't draw the box, breakouts aren't working, didn't draw the box. And so it's just one way that I use to, ideally keep me out of trades that I shouldn't be in. From a practical sense, I still take them. But anyway, I don't know if this is something that you would or do even use, Rocky, when you're doing option trades.
I do. It's interesting. I am more looking at, in this particular trade, for example, with Apple, you saw that it had set a floor at approximately 137, and then it broke through that floor. That when it came back down, and when it got up to 143 and came back down and tested that 137, that's what I would look for as my entry. that it tested there. It survived that test on that particular day right before July, the last day of June. And that's where, from my point of view, could be wrong, certainly, is that I would test it. It survived the test of breaking down once again, and it's a low risk entry that if it ends up violating the low of that particular candle the next day, then I'm out of that trade.
Works for me.
sense.
Yeah, I see what you're looking at.
Hey, Dan, can you do that on something like GDX?
Sure.
Because GDX, I mean, this one's already kind of broken out.
Yeah,
GDX. Yeah, and so GDX here, you know, this is an area where I think you could draw the box, and you have a clear kind of area where ideally, if this is trying to bottom, like Apple had, you know, tried to bottom, how would you do it on something like this?
Yeah, well, on something like this, it's actually, first of all, you know, you're going against the grain. You're predicting, you are kind of predicting a bottom if you're buying here, and that's okay as long as you know what you're doing. But the way I would look at this is go, you know, okay, the low on this day is 2604. Look at me, I pinned it almost exactly. Okay, so that's the low here. So then I would say the bottom of the box would be just a little bit right about there. So if you're doing, you know, if you're doing this methodology, you would say, all right, you know, this is your risk. You're risking on this trade. If the stock does come back and fill the box, you're risking 2%. So you should never, if you're doing this, your penalty should never be much more than 2%, because your whole thesis for getting in the trade is that this is a bottom. And so that thesis would be disproven if it turns out it's not. And so that's how I would draw the bottom box. And then, you know, the top box, you know, probably just to assess a risk reward kind of thing, I would say, all right, so the 20-day moving average is moving lower, or, you know, hasn't been up there for a while. But I would say that would be, you know, the top of my box here. And then another way to do it would be moving average. We'll use it exponential. 8.
Yeah, I think this is a really important exercise, because there's so many people, especially in the Stock Market Mentor forum, who are always looking to kind of catch that next wave up. And so this is a great way to visualize that risk defining area that I think if you're trying to catch a bottom, that you definitely have to consider that risk reward. I think that's important.
Yeah, I think it is. And this is a good stock to do this on. So what did I do? Okay, the 20-day moving average has been lonely, you know, for quite a while. But the 8-day moving average has not. It's been frequently visited for, you know, parties that never lasted too long. So, you know, you can see where it pinged here several times. And, you know, we could, you know, you could do this kind of thing in tonight's strategy session, Scott, or what we might want to do to, you know, to give this to Stock Market Mentor members too, is just edit out this, you know, until we get into options, edit this out so that we could send this to SMM members. Because it's, to me, this is really, really important stuff. You know, and I am not so secretly proud that that this was a methodology that I developed, that just like draw 2 damn boxes and then apply your experience and looking at over time, literally millions of charts, and then say, have I seen this before? And that answer is really also the answer to the question, is this a trade I should take? And so, as you know, to continue my thought, so this is the 8-day moving average going down, which has been hit several times. And so we look at this, like, let's say let's say it crossed here. All right, well, hell, that's a good 1.6% profit on the upside. And buying it here, it's 2.5% risk on the downside. Now, that's if this pattern continues. But the point is, that's not a particularly good risk reward trade for me. You could, if you chose to, you could draw a different box if you're really doing a tight entry. And so this one, the low is 26.14. Okay. Yeah. So this was a pretty nasty low here yesterday. You could just draw it at 26, but now you're just kind of using math. You're not really talking about trader psychology. So, I would look at this, and this is how I would kind of frame the trade as far as whether I wanted to take it or not. Does that make sense?
Yeah, totally. Sorry to continue the hijacking of your webinar here, Rocky. But
he didn't have much to say anyway.
Just wanted to show the difference
it's interesting because I'm going to be doing a crude drawing of boxes that I wanted to incorporate today. So it's going to be going to be interesting in going forward on what you all and everybody sees on the boxes that I end up drawing. So this is very interesting.
And by the way, it is an art form. This is not anything that you can really truly quantify. You can quantify, probable levels of support and resistance, but it is an art form. And so it's important for people to realize that. And to the engineers who would try to do that, you're kind of at a disadvantage because everything needs to make mathematical sense to you. And that's just the thing.
And that's why I say mine's going to be much more crude than yours is. And so I'm glad we went over it, and I'll continue to refine it as I go forward.
Okay, cool. I look at mine as pretty crude though. So yours has to be, I don't know, West Texas crude or something, but anyway. Okay, well, why don't you go ahead and take the screen?
All righty.
Rocky, we do have a question. I think this is more towards something that Dan was mentioning off the top because it came early from Paul, basically asking about a bear call spread on Apple. Dan, Paul is saying drawing a box back to May, it's at the top of the box. Would a bear call spread be the way to go? Or is there another bearish or neutral strategy that you could implement today on Apple?
Okay. Drawing the box back to May.
You may want to take the screen, Dan.
Okay. Yeah, okay. Drawing it back to May. I'm not sure. Okay, I'm reading it now. I just want to, sometimes the information gets lost in the translation. I've been interested in starting a bear call spread, drawing a trading box back to May. Okay, so we'll use back to May. All right, it's at the top of the box. I'm assuming you mean like here. Is that kind of your interpretation?
I think where it hits the 80 MA there, Dan. So you kind of have to draw it through that cluster in early June.
Oh, like so through the 8 EMA and through June and then back to here.
Yeah. So if you go up, you can kind of see like a doji hitting the top of the, I think that's where he means. Paul, maybe if you can clarify.
Yeah.
That we're looking at the right zone here.
Yeah. See, yeah, I mean, if you can clarify it, man, that'd be great. But as I'm drawing this, and this may not even be remotely relevant to the question that you're asking, but I'm just saying, as I'm drawing this through this, my thought is, okay, I don't know what's going on here because there's too much there's too much noise. Like you've got this up here, then you've got this. Here we'll do repeat. Then you got this down here, then you got this here, and then you got this, and then you got this here, and all of the, and then hey, let's not forget this. So all of these reflect like different little price clusters of varying degrees of volatility, and so yeah, and so anyway, I'm just looking at other stuff. And so this is just a flipping mess to me, and I'm not sure that any box that I would draw would be would be helpful to the analysis. It would just be if I'm interpreting your question correctly, it would just be me trying to apply something that I just learned to a chart that I'm just interested in. I mean, that's kind of the way I would look at it. So Scott, you got any more clarity on that?
Yeah. So he says that there was a low in March that broke in May, and that would be the top of the box. And then the low would be the 130 level. That would be the bottom of the box.
Okay. So a low in March that broke in May, and then say the last part again. So
that would be the top of the box.
Okay. This is the top of the box here. Okay, so this broke here. And so then what you're looking,
and then the 130 level would be the bottom of the box.
Okay. Okay, so that's down here. So the question is, can you write like a bear call spread, say, up here? I'm assuming something like that's the question.
I think so, yeah.
Okay.
Or is there another bearish or neutral strategy?
Yeah, well, that'd be something for Rocky, but I'll tell you this, it would not be my trade, and definitely feel free to step in here from a stock standpoint, because we got this, then we got this, then we got this, and we got this. And so this could very well be an inverse head and shoulders. No idea whether it is yet or not, but that's one thing that I'm thinking. And also you get a low here, and then a high, and then a higher low, and now a higher high. I wouldn't look at this as just like, oh, and here's a higher low. It's just one damn day. But you can see where you've got this kind of thing going. And so to anticipate that it's going to fail here, just because it has just this one time, I mean, I completely get the analysis, but I would just be careful because, this has had a heck of a rundown. They report earnings in 2 weeks, and I think it'd be a tough trade. Maybe more of a neutral trade or something. Like Rocky, what are your thoughts on this?
My thoughts is that I would definitely not be doing a bearish trade on Apple at this moment for a lot of reasons. Not only with what you just said with the potential head and shoulders, it's closed above the 50-day moving average right now. You can see that it tested it and is going up. The Bollinger Bands are opening up. So that is an indication that there's some positive momentum there as well. You've got an upsloping 8 EMA that you're showing here. If it ended up, the only bearish thing that I see on this right now is the fact that it's kind of getting into the cloud a little bit. But I don't think that the cloud's going to act as resistance on this particular on Apple. But I would not do it. In fact, I'd be almost looking at the other side of that trade. I wouldn't take it now. But if it came back and tested the EMA and held the 8 EMA and held, I'd look to put a bullish spread on going forward.
Yeah, I mean, if somebody has, if you're so inclined, you could do a covered strangle, where you're buying, 100 shares of stock at 150, selling the 160 calls, and then also selling like the 130 puts. I'm not looking at my trading platform. So I don't know how much you could get for those. My suspicion is not much because they're so far out of the money. But you could be doing something like that. And then what you're effectively doing is, you're reducing your cost basis quite a bit. So it's
Sure.
as if you bought the stock at a lower level, something like that.
Sure.
But I'm with you, Rock. I wouldn't be putting on a bearish trade. And even if the stock reverses, doesn't touch 150 and falls back to 140 or 130, I would still stand by that decision to not put on a bearish trade because I wasn't predicting anything. I was just looking at the risk. And so, sometimes, sometimes high risk trades work out great, and other times low risk trades don't work out. So you got to take each trade with the thesis that you're developing. So,
Yeah, the only other thing that he could be seeing here also is the previous low of that 151 back in the middle of March could end up acting as resistance on the way up at this juncture. But again, I don't know that I would end up counting on it to end up acting as resistance at this point.
yeah. And I mean, look, you can see, I just snapped a line at 150. You can see that this is a pretty key. It's a pretty key level. I mean, back here, you got a cluster for a while. This one rebounded right off of it. This knifed through it. And that would, by the way, if we were looking at this back here, that would be a key tell. It's like, wait a minute, the volatility squeeze broke out right here and volume increase. So this was a valid breakout here. This was a really, really good breakout. And so right around 150 was where this was. Not exactly, but this is pretty interesting level. And then when it gets back close to it, doesn't touch it, but it moves up. And then it comes back and bounces right off of this. And so you look at this and say, well, this is a key development. This is a key. This is a key development here. And then back here, is all important. And even here, it bumped up against it here. So 150 is a really, really important level. Okay, fine. So now what happens? So you see when the stock broke down below 150, that would be the time when, if you were long the stock, you would say, holy crap, I'm late for the door. Feet don't fail me now. You're going to be out of this stock, and you're going to stay out. And then, by the way, what happens here? It comes back to the 150 and then fails. This is actually your shorting opportunity right here. Failed at the 150, came back, tried to regain it. Oops, didn't work too well. And then you short. Now it turns out, it wasn't a monster short, but that's a short entry off the 8-day, and not off the 8-day, excuse me, just off the 150 price level. And then here would be another one when it pushed up above 150, didn't clear it for more than one close, and then you're down, then you're shorting it again. Getting into more short selling nuances, but the trick here is to just know that the stock's already come down quite a bit and it is still volatile. So you can't just look at this and say, oh, it failed, I'm going to go ahead and short it, because you have to look at this whole chart here and say, well, where's my support? Where are the support levels? And if it's down at like 135, which it kind of was then you're looking at just like we were drawing before when you're drawing boxes. Trade doesn't have a lot of upside in it, particularly for a short and particularly when it's Apple. And then I look at this and see, okay, the market's still weak. So anyway, I think I've probably worn out the reasoning on that.
Yep.
Dan, I think that that's a really great way to look at the chart, though. I think that's the kind of analysis that members need to do in this market to make good decisions, because it's so easy to zoom into short-term timeframes and get sucked into everything. But when you do a deep dive analysis like you've done on this chart, it really does bring clarity and say, okay, this is a clear resistance zone. If it gets rejected here, it may fail to the downside, but then it also may find support because that 50-day moving average is super close.
Yeah, I mean, I'll end my little, we can go as long as we want on options. But, I'll end my little dissertation, whatever it is, by saying this, guys. Trading is really frickin' hard here, and you can substitute a curse word for fricking if you want, because it's that damn hard. Trading is really hard here. And so if you let's say you're a new member, or, maybe not, but if you're sitting here in this environment, you're saying like, well, I just, I'm not really making any money. In fact, I'm losing some money. God, it's a good thing I have some kind of discipline, or I'd have lost my asterisk by now. But this isn't any fun. I thought I was better than this, or I thought, Scott or Dan or Rocky, though Rocky's in a different situation because he trades, in my view, high probability, low risk trades. But on the stock side, I thought Dan and Scott were going to help me make a lot of money. That would be an unrealistic thought, because the market's really effing hard right now. It just is. And so, I wish we could do something about it. Lord knows I do. But what you have to understand is, and I'm not making excuses for us, I'm trying to give you an edge here in your decision-making process. And you got to understand, the decisions that you make are 100% a byproduct of the emotions that are governing you at that particular time. There's no other reason, because you can be looking at the market and you want a certain thing to happen, and you need a good trade because the last 5, the last 10, the last 82, whatever, we're all losers. So you need a winner here. Okay, well, that's emotional. That's an emotional thing. Or on the other hand, you've got this fear of missing out. And so, yeah, stock's up and I'm chasing it and this and that. Okay, well, the fear of missing out is an emotion. This is why people sell at the bottom, because they're afraid that they're going to lose more money. That's an emotion. This is why people buy right at the top, because they've sat on the sidelines for so long watching that damn stock go higher and higher and higher and higher without them. And finally, they feel like this is the ultimate. This time is different. It's going to keep on going. I got to buy. That's emotion. In what you're not understanding, and this is a pro tip, you better burn this into your brain. The most stubborn bulls will all capitulate at the same time. As long as you're holding a stock that you're upside down on, you're hoping that it goes up. So you're a bull. If you're holding a losing position, you are a bull. As soon as you decide this is not working, now you're not a bull anymore. Now you're just an objective trader, making an objective decision as far as whether you're going to hold it or not. You're no longer a bull. And that's where, like, your rules, that's where stops keep you out of the emotional zone. But if you're holding this stock like everybody else is, and the stock keeps going lower and lower and lower, you get to a point where you're saying, okay, I can't afford to sell the stock now because I'm going to lose too much money. All right. Not only is that stupid, but it's also emotional. It's very emotional. And why can't you afford to lose that money? Because you don't want to be wrong. And why is that important to you? Because the only reason you held it all the way down was because you didn't want to be wrong. That's emotion. And so at the same time as you finally go, I gotta pull the ejection handle and get the hell out of this aircraft because it's taken a nosedive, everybody else does it at the same time. And why? Because it's emotion. And if you don't think this happens, you're nuts. It happens all the time. This is why there is a phrase known as a blow off top, because it's like a stock goes up, and finally everybody goes like, oh my God, I'm missing it. And it runs up like this. All right. Institutions aren't making that move. All the retail people are. Why? Because they're emotional, fear of missing out. And then it reverses and it starts coming down, boom, really fast. Why? Because they're emotional that way too. Also, institutions are not emotional. And so when the stock starts coming back, they're going, I ain't buying that piece of crap. And so the bids just completely drop out. And as the bids drop out, the stock goes further. And what are you thinking? Because you're the fool that's still holding that stock. You're emotional. And you're saying, the market's screwing me. The market's rigged. Everybody wanted my stock on the way up. And now suddenly the bids drop. Those damn market makers. Oh, those institutions. No, it's you, because you got emotional. And so emotions are what governs your actions. 100%. You can have the same analysis as somebody else and actually think the stock is probably going to do the same thing. And the emotional guy ain't going to make any money. The unemotional guy will, because they're waiting to see whether they're correct or not, because they're not emotional. They're objective. They're waiting to react to what the market's doing. The emotional trader doesn't wait. They act because they're emotional. Think about the term impulsive. Have you ever done something and it worked out well because you were impulsive? I mean, sometimes, yeah, but typically when something doesn't work out in your life, and it's a result of a bad decision, it's typically not the result of a bad decision that was arrived at by you saying like, let me think about this. Let me weigh pros and cons. Let me really give this some thought. Deliberate thinking, a deliberate thought process to get to a desired decision one way or another. Every well, with the exception of one, every really, really crappy decision I made was based on impulsiveness, because I'm an impulsive guy. So I'm really sensitive to this stuff. I do stupid crap at stupid times, and I'm getting better at it. You'd think at 64, maybe I'd be further along, but I am where I am. With your trading, where are you? Where are you right now? Are you an emotional trader? Are you looking at this market quietly yearning for this? Okay, well, this is not that. So you can't get emotional about it. You have to look longer, a longer time frame, but you have to be present today. That's really, really key for you to be present. You have to be in the moment, every moment, because if you're looking back, you can't do anything about that. If you're looking ahead, how much further are you gonna, how much further can you look without just basically being full of crap? Like, you don't know what's going to happen in the future. You have to be present, because only when you're present can you truly be aware of what your emotions are. If you're not present, you don't even know if you're emotional or not. So trade with presence, be in the moment. And if you can be in the moment without thinking about the past and without thinking about the future, Now you've got an edge on probably 90 to 95% of people that trade because you've got your emotions in check. But I'll say it again, if you think, well, I'm not emotional at all, either you've been trading for a really long time and have rigid rules that are just habitual for you, or you're probably not particularly self-aware. And if you're in the former group, then you know it. But if you don't know which group you're in, I think you're probably in the latter group. So anyway, so we got to just trade. We got to trade the market that we have and know that it's not going to last forever. It's not. And like I posted in a note earlier today, and then I'm done here. I posted a note earlier today. This is a really bizarre market. Like the wheels are coming off the wagon in virtually every sense. And seriously, unless you're a real politically biased person where, you know, you have trouble doing this, if you look at the people that are supposedly the elite, the global leaders and all that, they are mediocre at best. They're overlearned and overeducated, but completely lacking in vision and common sense. And so you've got this stupid war. You've got Germany thinking, way back when, he who shall not be named was telling them, like, you guys are really freaking stupid for, relying on Russia for all your oil. The whole Nord Stream pipeline, whatever it is, like, that's just nuts because you're putting yourself under this guy's thumb. And they laughed, arrogant, expletives deleted that they are. And now we're in a really, really screwed up place that frankly, we've never been before, at least in my lifetime, to where these things are so out of whack. Everything's out of whack. And however you think about things, you have to agree with me that things are really out of whack. And that is why we have so much volatility in the market. We got a lot of volatility here in the VIX. I suspect, though I'm not sure. Yeah, on the line chart here, this is still really, really choppy. Look at how wide this thing is swinging. Hey, baby, I'll be with you in a second. It's my favorite dog looking at me through the door. Big, wild swings here in the VIX. All right. Well, back here, when the market was moving higher, look how relatively tight the VIX was. Okay. It's not that way anymore. And why is that? There are a lot of reasons for that, but one of them is the wheels have come off the planet. And so you have to understand that. Now, ultimately, the ship is going to right itself. I guarantee you, I'll bet you any amount of money that the ship is going to right itself. Do you know why? Do you know why I can make that promise? I'll bet you my entire net worth. As many people as want to take the other side of that bet, I'll give it to you. I'll even lay odds 2 for 1. I'll go into debt that when in my bet that ultimately the ship's going to right itself. And do you know why I can be so confident about that? Because if it doesn't, I ain't going to have to pay you back. We're all screwed.
That's for sure.
Seriously. So you have to have that. You have to have that attitude that, things are going to work out. And they will. They just don't work out when we want them to, because frankly, I would have preferred they be worked out before all this stuff even happened. So just have faith in the market. Don't have faith in your political leaders on any of them, not one of them, because they're knuckleheads. You don't get the best and the brightest in Washington or Brussels, which I always thought that was a vegetable. But anyway,
great way to finish off.
I probably got people that are watching this that are getting the vapors here. So all I'm saying is just let the market work itself out. It will work itself out, and it will work itself out before it becomes apparent to you and me. because that's what stocks do. The volatility, hang on, the volatility will actually start decreasing, and the trends, the downtrends will start ending noticeably. And then we're going to start getting some leaders. We don't really have those yet. Not yet, but we will. Guarantee it. My entire net worth on it. What I'm not going to do is put a time frame on that. Okay.
Great way to finish off the webinar, Dan. I think I'll be cutting that part out of the webinar and sharing that with SMM members as well, because you are the king of trading psychology. Really powerful stuff, my friend.
Yeah, absolutely.
Well, thank you. Thank you. Yeah, Scott, do you want to take care of that editing stuff?
I certainly will. I certainly will be sure.
I think it was like the first.
That.
Now I got my dog barking at a bird. Anyway, yeah, I think this stuff's really important. Otherwise, I wouldn't have gone into it. But it is, especially now. So.
No, and you're right. You know, the market will show us that things are getting better before we start hearing about it in the news and on the headlines. And so that's one of the reasons I think it's really important to stay engaged every day and just follow what price and volume are doing.
Yeah, I'll tell you, you know, from my personal experience, there was a time back in the early 2000s, whenever it was sometime during that, you know, really brutal, horrible period, that I had other financial issues. You know, I dug myself into a huge hole, and I had to disengage from the market for a while. I had other stuff to do that was more pressing, and I was tired of losing money. It happens. And I was. And so I completely disengaged. I was barely even watching the market. And I missed out on some of the biggest monster moves that I've ever seen. Apple, Google, even Amazon, which was already up quite a bit. But I missed out on some major moves. And those were the early leaders. And why did I miss out on them? Because while the market continued to suck, some of these stocks that turned out to be legends, some of these stocks started going, and it was really, really obvious to those who were engaged. And why is that? Because they were obvious stocks and everybody was buying them except old Dan. So don't be that guy. You got to stick with it.
You mentioned things, you know, the toughest thing as traders that we face is sitting on our hands. It's time. We have to end up knowing that, it's not clicking the mouse that's making you money. It's actually sitting on your hands and doing it at the right time. And so many of us think that activity is profitability, but activity isn't profitability. It's actually the most time that you spend sitting on your hands, doing the analysis, making your rules, doing your studying. All of that stuff is what's going to pay off.
Yeah, it only takes a second to buy. It only takes a second to sell. And what happens in between is the result of your buying and your selling. But that's not the most important part of the trade. First of all, that stuff you can't control. Once you buy a stock, the only thing that you can control is how much you lose. And you can set that. You can decide that by a stop. So you don't even have to spend any time selling. It's just like, click of the mouse, set my stop, boom, I'm done. So what is trading? Trading is everything else. It's like one of the Wallendas said, hopefully not the guy who, you know, got blown off the wire, but one of the Wallendas said that life is on the wire, everything else is waiting. That's the opposite of trading. The waiting part is actually the work part where you're doing research. Like now, at this point in time, because the market's so crappy, you know, I'm not trading up a storm. Sometimes I have like 0 trades. Other times I have 5 trades that I wish I hadn't taken. Some I've got some that work, but this is not a market for me to really be making a lot of money. So have I taken up bird watching or finger painting or golf or something? Ball's too damn small, hole's too small, too much grass in between. Why would anybody do that? No, I'm working on other things with respect to trading, with respect to the market, even, with respect to like education for you guys. Okay, fine. But, a lot of the stuff I know, but a lot of stuff, the more I study it for whatever reason, the more I learn. Like Scott says, I'm the king of trading psychology or market psychology. Why do you think that is? It's because I am a voracious reader about the things that really interest me. And one of those things is psychology, is emotions, is mastering your emotions. I got a whole boatload of books, all of which that I've read, some of which I even study, that give me information that applies not just to trading, but to life. And that's the kind of stuff that really, really interests me. So I am becoming really good at that. And a lot of stuff that I spew out in stuff in venues like this, seriously, I didn't even know that I know that. And I think that happens to a lot of people where, if you're pretty well versed in something and you're explaining it to other people, a lot of times you'll astound yourself that you've learned from you. And it's because you know stuff that you didn't know that you knew. The only way you're going to learn that kind of stuff in trading is to keep at it, apply yourself, protect your capital. That's the number one rule, Fitzpatrick's first rule of trading. Don't lose your dough. If you lose your dough, nothing else matters. So don't lose your dough, but don't lose interest either. Work on your stuff. Look at all these webinars that Rocky's doing, that Scott's doing, that I'm doing. This is all good stuff. If it wasn't, we wouldn't do it. So put your focus in the right area. And if you can put your focus in the right area, then you're going to get the results that you deserve. Maybe not the results that you want, but you're going to get the results that you deserve. So get yourself to a point where you are deserving good results, and it will happen. Again, the ship is going to right itself. Promise you. If it doesn't, I know where my ammo is. You don't. So.
Awesome. Thanks, Stan. And Rocky, one final question from Bill asking about a covered call on Zoom.
Yes, I still, I'm out of the covered call on Zoom. I still have the butterfly that I ended up putting on there, the August 12th, 120, 135, 150 fly for August 12th. And for the same reasons that I am in the Baidu trade and so forth, until this ends up, if it closes below the 50, I'm out. And I just think that you've got a chance that it's going to end up stabilizing here. But if I'm wrong, I know what I've risked. It's not that, it's $3.10 or $3.08, $308 per contract. I'm comfortable with that risk, allowing me to stay in the trade. So I'm still in the trade.
Fantastic. Great session, guys. Yeah, really appreciate all of this. This has been great. And I'll be sure and try and get this posted in the Option Market Mentor forum and emailed out, and then send some of this to Stock Market Mentor members. And just so you know, if you didn't get any or didn't get your question to Rocky, be sure and post it in the Option Market Mentor forum.
Hey, one thing I was going to mention on Zoom with respect to the covered call. If you sell the August, the standard contract, the August 19, 110 call, basically at the money. If you sold that, you're going to have a cost basis of $100. And so it's effective. If you're selling the 110, you've effectively bought the stock at $100. Now, the bummer is if the stock goes up to 110, you've made 10% on the trade, which sure like to make more. but at least you made 10%. So just kind of keep that in mind. That's a type of trade that you could do. It's not one that I'm making right now, but somebody asked about covered call on Zoom. So, you know, it's a way to get the stock like, hey man, I had a good trade. I bought it below the 50-day moving average. Looky there. So anyway, take it for
Also,
what it's
keep in
worth.
mind, you can always roll that forward if you end up doing it. So if you sell the covered call at 110 and it ends up coming up to that 110 level, you just roll it up and out.
Yeah. And by the way, this trade where you're selling an at the money call, that's a really conservative trade, you know, but I don't know in this market. I don't know if I would want to do anything that was not really, really conservative.
Yep.
So anyway.
All right.
Okay. Are we done?
I think we're done.
I think so.
Okay, guys, great session. You know, went longer than we usually do, but one of these days we're not going to keep saying it went longer than we usually do. So it seems like this is the usual amount.
It goes as long as it needs to go.
Well,
Amen,
and that's
baby.
it. You know, in this time, the people need us more than ever. So
That's why we're doing these, frankly. I'm thinking like when the market gets really starts to really rocking again, are people still going to expect like so much kind of hand holding and stuff? And first of all, it doesn't really matter. But second of all, I don't think so, because people aren't going to need that much hand holding, you know, but right now, you know, kumbaya, you know, we all got to hold each other's hand and get through this.
Awesome. Okay, guys, we'll see you in the forum.
All right. See you guys. Thanks.
bye-bye now.